So good morning, everyone from Prague. It's me here with the Q1 results for 26, which is good because we have seen a all-time record high leasing take-up of more than 762,000 square meter of new deals. Around 445,000 square meter of that is new build, new deals, and the rest is some renewals throughout the region. Mostly for existing clients, long-term tenants, as historically around 2/3 of all of what we lease to our existing clients. So those are logistics service providers, DSV, Raben, and many others. But also we have been able to close in Q1 a number of deals in Germany, in Krefeld, which is one of our new projects in Germany, but also some renewals in Romania, for example, Valeo and Timișoara. We have done a deal with Laurent Merlin in Bucharest. So all kind of different industries. But yeah, very good. So a record high. We've never seen so much leasing as we have seen in Q1. And I think Q2 going to be a record again in terms of take-up. But let's see how far we get. This confirms strong client base and confirms a right region. I think also confirms that with all of these events happening over the past weeks, months, decade, maybe. We've seen COVID, we've seen tariffs, we've seen wars. Often our clients adjust their supply chain from, just in time becomes just in case. They want to build inventory. They cannot rely on the Suez Canal being open all the time. So rather have a bit of extra goods on stock. More in Europe, for Europe is what we see. Mostly Central Europe because labor cost, productivity is different here than in some of the Western European countries. And often means that our clients are growing their business and building inventory just to make sure that they can deliver if they need to make sure that they can sell and continue to run their business. All of this also means flexibility. Leasing or renting property is therefore also very much in demand and appreciated and gives more flexibility. It's not that companies build properties which they will use for the next 30 years. It's more like they want to maybe rent something for 5 years or 10 years or even short-term leases is what we do. And short-term leases can be at a bit higher rent than long-term leases, of course. Us as well established, companies with feet on the ground here in Europe and Central Europe in particular. I think we benefit from that with the client base, with people on the ground, with a network. We've been doing this for, more than 25 years. So we benefit from that. And Europe cannot rely on others. You need to maybe re-industrialize, as some people say. Anyway, become more self-sufficient, look after your energy business, technology, but also defense industry. And also for companies outside of Europe, also they come to Europe to be part of the European economy. And we've seen that many Asian companies come to Europe. We do a lot for them, and I think it's going to continue. And they also come to Europe under the In Europe, for Europe idea. Some highlights on the operator and developer, because I don't have to tell you that we collect rent, because we always do that. And occupancy has been around 93%, similar to what we have seen over the past 5 years since our IPO or since the listing in Amsterdam in 2021. Okay, operator. So far good. 14.7 million square meter of lettable area, which produces 850 million euro of rental income. For next year, 2027, as you know, we target 1 billion euro of rental income, and that is still a realistic target. That's with regards to the operator. With regards to operator, I can also say maybe that we continue to invest money in those buildings, make sure that they remain in excellent condition. What do you do? All kind of modernization, smart metering. Of course, we equip those buildings with LED. We did and do some roof repairs, all kind of other things to make sure that these buildings remain in a good condition. Often these buildings are obviously part of a larger business park. Yeah, it's just important, we believe, to continue invest in those parks, not only the buildings, but also outside infrastructure, etc. For example, it reminds me of a project in Brno, Madrid, south of Brno, which we started in 2001. And then we now recently built another exit from the motorway to improve the accessibility. That's what we do. We also improve in green areas and parking lot and some battery charges. So you make sure that these properties are up to date and fit for use. And they've been built well back in the day. So yeah, that's the operator, a developer, the stuff we like. 2 million square meter under construction throughout the portfolio, 11 countries. Not all of that will be complete this year. Some properties take a bit more time to complete, but once fully let, it will do another 150 million euro rental income around that. Keep construction cost in under control. Obviously, there's a bit of here and there discussion about construction prices. Try to keep that under control. I think we can do something on rental growth as well. We have a large land bank, which we like to develop. So we are working on design and permitting to make sure that the land bank is prepared for future projects at the same time. So the developer is not only building buildings, but it's also preparing for future developments, which often is, I think, probably the most demanding, because you need to do a proper design and you need to get your permits. And that's something which can take time. Once you're under construction, then you control that process and then you're okay to estimate your completion dates. Target is to remain at 10% yield on costs. Do that, continue to do that. Lots of existing clients. Also, as I said, adjusting supply chain, adjusting strategy to the new reality. Flexibility, also being able to react to the changing market circumstances goes for our clients, but also goes for CTP. I mean, in times of change, there is opportunity. When all is steady, then it's easy. I think you can make a difference when it's a bit bumpy and more challenging. And this is something which we enjoy, which we like to make sure that now is the time to make a difference. So it's all hands on deck. It's the time of opportunity. And all together work for a better and stronger Europe, for sure. Asia, yeah, of course, we continue to look. We have teams on the ground in China. We have a team in the meantime in Vietnam to make sure that we understand the market. We talk to our existing clients on whether they would go to Vietnam with us and how that would look like. Many of our existing tenants have activities in Asia and many are in Vietnam already. We could have been part of that maybe, but we were not ready. And I think we are getting up to speed to be prepared and to see how we could extend our activities and also become active in Asia. And Vietnam would be then the first market for us. I continue to go there. As you know, I'm typically involved in CTP when it's a startup, when the things start to go, before we hand over to local country teams. So I do plan to continue my travels to Vietnam on a monthly basis approximately and try to spend a week in Vietnam. So far good. This year I will hand over to my colleagues, and I'm happy to and ready and prepared to answer any of your questions. Thank you so much.
Turning to the financial highlights. The portfolio like-for-like rental growth came in at 4.6% for Q1-2026, accelerating from 4.2% in Q1-2025, driven by indexation and continued positive rent reversion capture. As Remon highlighted, we delivered a record quarter leasing activity of 762,000 square meters, up 83%, and occupancy remained stable at 93%. The annualized rental income increased by 14% year-on-year to 849 million euros, illustrating the strong cash flow generation of our portfolio. We remain well on track to achieve our annualized rental income of 1 billion euros by 2027. This cash flow will finance our future growth. Our company-specific adjusted EPRA earnings increased by 11% year-on-year to 120 million euros. This translates into 25 cents per share, an increase of 9% compared to Q1-25, adjusting for capitalized interest. We remain on target to meet our full year 26 company-specific adjusted EPRA earnings per share guidance of €1.01 to €1.03. Now looking at the valuation results. For the Q1 and Q3 results, only the investment properties under development are revalued. In Q1-26, the revaluation amounted to €164 million, driven by the construction and leasing progress, allowing us to capture the development profit on our pipeline. Of the project delivered in Q1-26, we achieved a yield on cost of 10.4%. The total portfolio gross asset value now stands at €18.9 billion, up 2.2% from full year 25. And the supportive demand drivers of our business are not just prevailing, but are becoming even more relevant given the current geopolitical environment. Whether it are European companies reshoring or global companies relocating manufacturing to Europe, and in particular to the business-smart CEE region, to more effectively manage their supply chain risk. And these changes bring opportunity. And we are ready, not only with the 2 million square meter of space under construction today, but as well with our 33 million square meter land bank. This enables us to capitalize on our high development yield on cost. We also continue to grow with our existing customers. 73% of the new leases signed in Q1 are with existing clients expanding with us. And our tenant retention rate was high at 95%. Of the space under construction today, over 80% is in or around our existing parks, where we continue to see strong demand, especially from those existing clients. Our EPRA NTA per share increased from €18.58 at Q1-25 to €20.95 at Q1-26, representing a strong year-on-year increase of 12.8%. We have now been 5 years listed as CTP, and in those 5 years, we have delivered an annual growth of 19% in terms of GLA and 22% in terms of the annualized rental income. But this is just the start of our self-financed, development-led business. And it's supported by our standing portfolio. It's sustainable and growing income, alongside market expansion opportunities. Looking forward, structural tenant demand drivers, including our medium-term double-digit annualized growth trajectory, remain unchanged, as Richard will highlight to you now.
In Q1 2026, we have again demonstrated our strong access to debt capital markets and our continued focus on diversifying sources of liquidity, raising nearly €800 million of new debt during the quarter. We seized a favorable market window early in January and issued €500 million of green bonds with a 4.5 years maturity ahead of the geopolitical volatility that followed. The bond was very well received, with an order book almost 9 times oversubscribed, and provided highly attractive funding at a spread of only 92 basis points, our first issuance below 100 basis points since 2021. Following our inaugural Samurai loan from March last year, we also returned to the Asian markets with a new dual tranche 5-year syndicated loan, raising 22.5 billion yen, equivalent to €122.7 million, at a margin of 115 basis points, and $180 million at a margin of 135 basis points. With 15 Asian banks in the syndicate, we further broadened our pool of lenders and strengthened geographic diversification, both of which remain long-term strategic priorities for us. We also continued to actively manage our debt portfolio and repurchased €216 million of our February 2030 bonds with a 4.75% coupon, generating material interest savings over the coming years. Supporting our integrated business model, the developer, the growth engine, the operator, we will continue to proactively manage our debt portfolio and diversify funding sources in support of long-term value creation. Turning to the key debt metrics, our interest coverage ratio remains stable at 2.5 times, comfortably above covenant level. Our normalized net debt to EBITDA stood at 9.4 times, broadly stable. And our loan to value stood at 46.4%, marginally above our 40 to 45% target range, primarily reflecting the land bank-led acquisition in Italy at the end of 2025. We believe this acquisition will be highly accretive over time. Importantly, the next stage of growth is built in and financed. To complete our 1.4 to 1.7 million square meter pipeline in 2026, we do not require additional equity capital due to our sector-leading yield on cost of around 10%. Every euro we invest in our pipeline increases our ICR and decreases our net debt to EBITDA as leasing income comes on stream. That underpins our confidence that we can continue growing rental income at double-digit rates while strengthening the balance sheet. Looking through 2026 and beyond, CTP maintains a conservative debt maturity profile. We also repaid 350 million euros of bonds maturing in January, and our only remaining bond maturity in 2026 is 275 million euros at the end of September. Looking further ahead, maturities remain limited over 2027 and 2028, with less than 1.1 billion euros in total outstanding over those 2 years. Liquidity at the end of March stood at 1.9 billion euros, comprising 600 million euros of cash and our 1.3 billion euro RCF, more than sufficient to meet our cash needs for the next 12 months. We continue to rebalance our capital structure towards unsecured funding, currently at 71% with a medium-term goal of around 80%. Our average debt maturity is 4.8 years. 99.9% of our debt is hedged or fixed rate, and the weighted cost of our debt decreased to 3.2% in Q1, marginally below year-end 2025 due to our active liability management and refinancing activities. We do not expect a material increase in our average cost of debt in 2026. We remain confident in the outlook for CTP, despite the volatile geopolitical backdrop. Operationally, the quarter was marked by record leasing activity, while rental levels remained resilient. We continue to see structural drivers, such as rising disposable incomes, supply chain professionalization, and in Europe for Europe production, supporting occupier demand across our markets. Our pipeline remains highly profitable and tenant-led, with 2 million square meters under construction, bringing 154 million euros of future rental income and over 7 billion euros of development profit potential in our land bank. This provides significant embedded growth well beyond the current year. More broadly, we remain firmly on track towards 1 billion euros of annualized rental income by 2027, supported by development completions and reversionary capture, while continuing to progress towards our longer-term ambition of 30 million square meters of GLA. Thank you for your attention. We now welcome your questions.